Good afternoon, everyone. Thank you for stopping back in. Banks are on the fringe of collapse, or are they? Last week, I spoke about $1.2 trillion in commercial real estate is going to hit a maturity wall, meaning they're going to come into maturity within 2024 to 2026, within the next 2 years. And almost half of that number, 645 billion, is going to be in multifamily real estate. Today, I'm going to update you on some of the data that the FDIC looks at and puts out on troubled banks. So we're going to see, are they in trouble or are they not in trouble? I'm Rob Napolitano. Welcome to How to Protect Your Assets Through Chaos, Conflict, and Crisis and Achieve Portfolio Performance. I want to help you to protect your assets and wealth while enduring and even thriving through these headwinds that we're experiencing today in these economic times. In 2008 to 2010, I got an inside look at how the real system works because I was riding high, closing $40 million a month in mortgage loans in my own mortgage company, and had the rug pulled out from under me, lost everything. I went into a bankruptcy, fought my way out of it, and I'm one of the very few people you'll ever meet that actually went into a bankruptcy in a Chapter 13 at a certain net worth and actually came out at a higher net worth, beating two of the biggest banks in the world with inside the bankruptcy. And from there, I learned how the banking system really works. And I realized that average people like you and I, that we're basically left to fly blind today in investing. And that's why it's important. And some of the principles that I've adopted is that it's important to have the three biggest things in order to thrive in chaos, conflict, and crisis. Is to have education, take quick and decisive action, and limit your costs and conflicts. So when I learned all that and developed these principles, I felt that was a personal and a professional responsibility to start educating people and sharing some of the insight and cut through some of the noise and bring you facts backed by data to empower you to make more intelligent decisions and more informed decisions. And so here, every week, we provide independent, verified facts so that you may proactively act in defending in your wealth and your legacy. Why? Because our wealth and our legacies and our livelihoods and our lifestyles are holistically being attacked today and encumbered. They're encumbering our freedom at an unprecedented rate. And how are they encumbering our freedom? With this unconventional warfare, and the most effective weapon of choice is debt. Government debt, public debt, commercial debt, and even consumer debt. And so we're here to challenge and attack the outstanding debt and to actually make a profit off of it. There's a lot of noise, a lot of change going on in the world, and it creates confusion, it creates complexity. And with that brings disruption, inefficiency, misalignments. But in the midst of all that, it also offers opportunities, ready to be seized by those who are ready to get educated by them and those that are ready to take quick and decisive action. So if you want to take advantage of these inefficiencies and these misalignments, then I invite you to listen for the next 8 to 10 minutes and stick with me to the end, and I'll show you how you can actually take advantage of some of these opportunities. Because remember, the most prepared wins every time. Today, I'm going to show you a report from the FDIC that does a quarterly banking profile, and this is as of the fourth quarter of 2023. And it looks at the performance of all the insured institutions. So what we're actually showing you here is how U.S. lenders and the problem bank list rose again in the last quarter of 2023. That's what we want to glean from this and what we to take away from the next couple of minutes. Okay, I'm going to show you a couple of charts and show you that lenders had struggled to cope with higher interest rates and more overdue loans for commercial buildings and even credit cards. So let's show you the first chart here. Okay, this is going to be the number of assets on a bank's problem list and the number of problem banks that are on the list. Okay, so the FDIC takes a confidential tally of lenders with financial and operational and managerial weaknesses, and that has grown to 52 banks currently, representing only 1.1% of the institutions it oversees, which may seem nominal, but the total assets held by these firms that have increased is 12.8 billion, which is not an insignificant number, for a total of $86.3 billion of assets being held by these troubled banks based on these measurements. Now, it's interesting to see how this chart back in 2022 going into 2023 had a big spike and then came back down. So if you remember in 2023, when we led up to this problem. Well, the inclination of this problem. This problem has been existing and has been dormant on banks' balance sheets, but as it started to expose and rear its ugly head, the end of 2022 going to 2023, remember a year ago this time that the bank came out with a bank term funding program, which was a short-term 1-year funding program to provide liquidity for the banks. And so that helped to stabilize some of the banking system. That's why part of the reason why you see some of the troubled banks that are on the list, and with the trouble of the assets they have here, took a big dip because the Fed came and rescued them. So also, although this is a number that remains relatively low compared to historical highs, it does continue an increasing trend that started early last year. And so the industry does face significant risks that could affect credit quality, profits, and liquidity. And so the FDIC chief flagged concerns around commercial real estate loans specifically. Moving on to bank income. So this is the quarterly net income by the banks. Okay, so the aggregate net income for the FDIC commercial banks and savings institutions declined by $30 billion, or a 44% from the prior quarter. So you can see that drop down from the one quarter to the next, from the 79.8, I'm sorry, from 68.4 down to 38.4. You can see that significant drop and that plummet, and that represents a 49% drop in net income. Higher non-interest expenses also, and lower non-interest income and higher provision expenses are up, and that's what helped to diminish the net income of these banks. And what does that mean? That means that they're taking more of their income and marking them for reserves, provisional expenses, which is reserves, and primarily those reserves are set aside for commercial real estate loan losses and credit card losses and write-offs. So they're starting to put their money on the provisional side as opposed to writing them as income. So that means they see something coming. They know there's more coming, and they got a reserve for these losses. And there you go. Here's the next chart that we show you, is that the charge-offs are accelerating above pre-pandemic level. 14 basis points from the prior quarter, and 29 basis points from the prior year, and 17 basis points above its pre-pandemic average. So now the FDIC now estimates that a $20.4 billion in losses are arising from the failure of SVB and the New York-based Signature Bank, which is up 25% from its original estimate of 16.3%. The industry net charge-off rate is 17 basis points above the pre-pandemic average. So you can see that these charge-offs are starting to increase. The banks know there's more coming. It's not making it out to mainstream media, mainstream data points yet, but you can see that it's actually on its way because the banks are actually preparing for it. Let's go to the next one. CRE non-current rate. These are the loan delinquencies. This shows you that loan payments on commercial properties that are owner-occupied are at the highest level since the first months of 2014. So delinquencies are on the rise as well. You can see how sharply these delinquencies have gone up since interest rates have increased by the Fed. And this goes in line with what we talked about last week, that there's going to be issues with all of these loans that are going to be mature 2024 to 2026. Now that they're having trouble making these payments, having them refinanced or taken out is going to be a big problem. So we're going to see a massive wave of defaults based on this data, is what we're predicting. Well, it's what we're seeing anyway. Okay, so the next chart here is for credit cards. So the credit card delinquency soaring, highest rate since 2011. And the credit card loans are seeing an increase in net charge-off. Delinquencies on these credit cards have been the highest, as I said, since 2011. And the charge-off rate was about 4.15%. And that's the highest rate that's been reported since the first quarter of 2012. So we're going back to making references to the great financial crisis. And as a side note, residential mortgages also drove quarterly increase in the share of loans that are past due. So that's the data of the 5 charts. But apart from all that, Powell said in the last couple of days that still the banking system is resilient, and that the banking failures from the banking failures from the commercial real estate loans, they're going to be there, but not at big banks. And repeating a comment that the troubled commercial real estate loans are manageable and more of an issue at smaller and medium-sized banks. So what he's saying is we don't care about the little banks. We don't care about the small regional banks. They're going to go away. They're going to fail. The bigger banks will try and pick them up, again, which creates opportunities not only for those banks, but also for the private sector as well. So, as I said before, that we are living in an environment where there's a lot of noise, and it creates what I call the 5 C's: chaos, crisis, conflict, confusion, and complexity. But the good news is that in the midst of all of this, there is opportunity. But you have to be informed of where the opportunities are so that you can make decisions about which opportunities are real and which ones are actually right. Because there is a difference. I'm not trying to bring you some of that clarity so you can gain some confidence to protect your assets and grow your wealth in a sound and efficient manner. So I invite you all to come every week that I try to bring these insights to you. But I also invite you to get in touch with me directly. So you can get in touch with me directly if you have some personal things that you need to discuss. I'd be happy to talk to you. You can go to GIT, which is get in touch, git.gritrust.com. Fill out the information there. My team will put you on the calendar and we'll have a one-on-one conversation, not to sell you, but to learn more about what it is that you're doing, where I'm able to provide some insight, and maybe give you some guidance on what you need to do for yourself personally. In addition to that, if you want to just see more of what we're doing, we have private showings of executive briefings, and we're going to do one on a monthly basis. Get on our guest list for that. Go to more.gritrust.com. Just put your information there, and we'd be happy to send you out an invite and become one of our guests on our future monthly executive and interactive sessions that we do. Or if you want to just continue to see these videos that we're doing every week, just go to vlog.gritrust.com. No matter which way you go, I want to hear from you so I can help you. Remember, the first part is education. Part 2 is to take decisive action. So that is up to you to take decisive action. So I look forward to hearing from you and looking forward to interacting with you and seeing how we can become better at protecting our assets together. So with that, I wish all of you a prosperous day. And until next time, talk to you soon.